Welcome back to Click Capital, everyone, your go-to channel for the latest daily fundamental and technical analysis of the markets. And another quiet day here on Wall Street. S&P 500 only cracked 14-point range between the high and low, which was even a shorter range than yesterday. So today is the tightest range day all year and also the lowest volume day all year as well. We can see here on the SPY, we only did 49 million shares. On average, we normally do about 76 million shares. So the markets are calling up significantly here. And a big reason for that is because of these guys here trying to work out a debt deal. They are meeting together at the White House as I speak. There might be a little news come out by the time I post this video, but I don't expect them to come out with a deal today, as both sides are pushing hard for their political demands. So we'll probably get a last minute deal, and the market may be a little bit on edge, nervous until then over the next couple of weeks, as the US government is expected to run out of money sometime in June next month. And what's also got markets in a wait and see mood is the CPI data we've got due out tomorrow. So inflation year over year is expected to grow 5%. And this is one of the last big data inputs before the Fed meets again next month to decide on the interest rate decision. And right now markets are trying to decide whether the Fed is done in their hiking cycle. So this will give us a bit more look into that. As Jay Powell did say, they are going to be looking at incoming data to make their decision whether they are going to go on pause or not. So if this comes in below 5% tomorrow, this is more likely the Fed is done hiking rates. However, the markets did increase their probabilities that we are going to get a hike today, with the June Fed Fund futures contract implying a 21% probability that they will hike. That was up from 13% yesterday. So even though it was the tightest daily range all year as measured between the high and the low, we did gap down and held a little bit. So there was a bit of red out there today, especially in tech and in semis especially. And industrials and consumer defensive held up somewhat. Fear and greed still at a healthy 61. DIX index still slightly bullish at 50%. And corporate insider purchases exceeded sales yesterday, 142 to 99. Super quiet day in the options market, as you'd expect. Only 28 million contracts changing hands, 54% of them calls, and high yield again, 95% of the volume done in puts. And as we expected, US government has been likely buying the dip on oil, as we saw another bump up in prices today, and news out now that sources are saying they are going to fill up the strategic petroleum reserve at some point this year, which should keep a good floor under crude, because anytime it gets cheap, there's just a good incentive there for the US government to refill. And I would suspect they would use any opportunity they can to refill it, especially with growing geopolitical tensions and what could spill over to more wars with Russia and China. It would be good to have some spare oil on hand. And like this article says here, the Biden administration's use of the SPR has been a highly charged matter for oil bulls and opponents of President Joe Biden. Both sides accuse him of indiscriminately releasing stockpiled oil to subdue crude prices and shore up his political standing with American voters, when the reserve is meant for emergency use in times of critically short oil supply. And just looking at the price of crude here, we're at $73.50 a barrel. We can see we're really bounced hard off this $65 support level last Thursday, and currently in a pretty good bounce here, because like I was suspecting, anything under $70 is a pretty good buy for the US government to refill the SPR like they really should soon. Plus, I don't think OPEC wants to see oil below $70 a barrel here, because last time that happened, they got together and met and made a meeting around here. Obviously, that was leaked, it was bought, and then they came out with the news here that OPEC's going to cut supply by 1.1 million barrels a day, because I'm pretty sure they want to keep oil around this 75-80 level, which is kind of the sweet spot where it doesn't affect demand too much and keeps their profits nice and healthy. And there's a bit of growing division in the Fed, as some presidents are still saying that rates need to be increased to get inflation back down to their target of 2%. And New York Fed President John Williams just reiterated this and told the Economic Club of New York that we haven't said we're done raising rates. And he said he doesn't expect inflation to return to the Fed's 2% goal until the next 2 years. And goes on to say that unemployment's likely to rise to a 4 and a 4.5% range. But of course, they're watching how this banking crisis is going to affect the economy with tightening of credit. And I find it's a good idea to pay attention to what these Fed presidents say, as they can speak a little bit more freely than Jay Powell, who doesn't want to spook fear in the markets and can't really talk that openly about going into a recession and high unemployment and that, as he has a bit more of a political mandate hanging over him. But I think what this guy here, John Williams, said is pretty realistic. They're not going to get back down to 2% anytime soon, maybe not until 25, 26. And here's a long-term chart of the Fed funds rate going back to the mid-50s. And it could be that a lot of people and the market is hoping that we're going to get a cut. However, like the New York Fed president said, we're probably not going to get back down to 2% anytime soon on inflation. And if I just overlay this chart with the inflation rate here in the orange line, we can see last time we had this really high inflation back in the 70s. It took over 10 years to reverse the uptrend in inflation. And typically inflation doesn't turn down until the Fed funds rate gets above the inflation rate. And whenever there's a gap between the inflation rate, this orange line, and the Fed funds rate here in the blue line, typically that gap closes with the Fed fund rate climbing higher. And we can see that here, here, here. And right now we still have a significant gap between the inflation rate and the Fed funds rate. So either inflation has to come absolutely crashing down, which is kind of hard to happen with a real tight jobs market, or the Fed funds rate has to go up above inflation rate to really get on top of inflation. The question is what's happening in the banking sector with the credit crunch and tightening lending standards and regional community banks going under and all that. Is that going to cause enough damage to the economy to really get this orange line inflation rate down so the Fed can pause? But they may have to pause longer than usual because we did see inflation spike up over 12%, so it shouldn't be just going back down to 2% anytime soon. And wouldn't be far-fetched to think that we don't get back down to 2%, maybe not down till the mid-late 20s. So it could be a story of higher for longer with rates and not just a fast turning back down in the Fed funds rate like most of us are used to in our careers. Always the Fed has paused just for a few months or so, then they've turned back down really quickly. We could be in something completely different here altogether because we did get inflation above 12%, and this last 10-15 years the Fed has pumped an extraordinary amount of liquidity into the system and grown their balance sheet from 1 trillion back here to over 8 trillion now. So personally, I think I would be surprised to see inflation back around 2% in the next couple of years. I think it's going to take a long time. And let's not also forget what's brewing in the background is the Ukraine war. President Zelensky says Russia's intensifying their attacks out of frustration, and both sides, the West-sponsored Ukraine and Russia, are not going to back down, so it's hard to see this not reaching a boiling point, which can't be a good thing for the markets. Although there probably is a small chance that China is going to try and broker a peace deal as they want to be seen as the new world leaders, but I'm not so sure about all of that. And this continues to remain a tail risk for the markets. Okay, let's head on back over to the charts. International stock indices just kind of hanging around there too on low volatility. And here's the new VIX one day doing its job. So it predicts volatility in the current day and for the next day as well. And so that shot up 61% today to 18 as is expected. With that inflation data tomorrow, we're going to get a few moves in the market. Same with the VIX 9-day as well, and the normal VIX 30-day moved up today, even though we had the tightest range. Implied volatility is of course forward looking. However, I would say given all the events, the volatility is still very suppressed and low here. And this has been kind of a strange phenomenon, which I think the 0 to 1 day to expiry options is having a bit of an effect on. And there continues to be no fear in the market as the volatility term structure is still in a normal contango curve, with higher values the further we go out. Volatility, the VVIX index, is still a little bit elevated here at 92. And surprisingly, there's not many people buying puts out there. The put call ratio only 0.82. So most option trades are still overwhelmingly call options. And breadth continues to struggle here with 39% of stocks above their 20-day average. Growth versus defensive sectors flirting with their 50-day here. Gold having another really strong day versus treasuries. Inflation expectations still trending down a little bit. And bonds calling up a little bit going into tomorrow's CPI report, with the 2-year just above 4% and the 10-year just above 3.5% here. June Fed Fund futures holding the line at 509 as well. And TLT coming off again and approaching a bit of a support here. May look to fill this gap that we got after Silicon Valley Bank news on the 10th of March. But I'll be looking for it to hold that as support, because if the Fed is indeed done with hiking rates, then TLT could be a good buy here. And just a quick look on the monthly chart of TLT, it has been trying to put in a base here for over half a year. And that's after coming off almost 50%, its biggest drawdown ever since it came onto the market back in the early 2000s. So when bond yields drop, the price of bonds go up. So once the Fed communicates it is done hiking rates, we may see a breakout of TLT above 110. However, we really need to see inflation coming down for this thing to really grow back up into the 140s, 150s. Because if inflation stays around the 4 or 5%, we're not going to see Fed funds rate get back down to that level anytime soon either. High yield bonds still below their 50-day as well. Dollar still holding 101. Commodities still holding up here in major support. And gold still floating with all-time highs above 2,000 an ounce. Uranium had a really strong move up today, up 2.2% on volume. IPO stocks stood out a little bit today, up again here. Along with the overvalued stuff, ARC getting back above its 50. Semis came off 1.54% today. Biotech's been really strong of late, found new highs today. Big banks continue to consolidate in a sideways pattern. Regional banks, lower lows, lower highs today, looking to come down and test support again. High highs, high lows on home builders again. Got a bit of a bounce up here in aerospace and defense stocks. Healthcare stocks coming back to test their 50, and staples and utilities still holding above theirs. BlackRock coming down to test lows again. Tesla gapped down a bit on low volume. Same with NVDA, down 2% off 290. Apple found lower lows, lower highs. Microsoft calling up too. Google ripped up to new year-to-date highs early in the morning above 110, but was quickly rejected and sold off and finished down near its lows. And that can be a little bit of a telltale sign, not only for Google but the market, when a big stock like Google breaks out but then it's quickly sold off and finished down near the lows. That could create a fake out, and basically what that says is there was sellers waiting up there at 110 to take advantage of those high prices, and then the market sniffs that out and finishes on the low, and so that could cause it to go the other way, and we could see a close below the 50 in the upcoming days. And that could be significant because it's been mega cap tech that's really been holding this market up this year. So if we see a big stock like Google close underneath its 50, the other ones may follow suit as well. Meta's still trading soft after its earnings gap up. AMD just kind of holding there. And meme stocks still kind of holding up as well. Here's AMC, that was off a little bit today. But GameStop and Carvana is back above its 50 after it reported earnings a few days ago. It only lost $1.51 a share versus $2 expected. C3 AI moving up a bit too and coming back to test this support resistance zone. An EV maker, Lucid, reported worse than expected numbers today, losing 43 cents a share. Market didn't like that, marked it down 5.5%. And just as I speak, Airbnb has reported their numbers and it's come in worse than expected. Reported 18 cents a share versus estimate of 21 cents. The market doesn't like that. We're down 11.3% in after hours. And so this stock's up pretty good this year. If we started the year in the mid 80s, we're here at 127. And this is a good look at discretionary spending in the economy. If we just go out to a weekly chart, we can see that's come off a lot since it was back above 200, but it looks to have found a bottom around the low 80s. And travel has been holding up okay this year as everyone still has a job. However, if we do get that recession like the bond market is predicting, I can imagine a lot of people will pull back on spending like things on Airbnb. However, according to our stock fair value indicator, we've got fair value at 126, right where it traded and last closed. So it's not too overvalued to begin with. So even though I think the recession could really hurt this company and stock, it's not one that I'll be shorting because I like to short ones that are really overvalued to begin with. And with a further earnings decline, that's when you really see those big falls come in. As typically when a stock is trading on a huge multiple, when that stock reports weaker growth than expected, not only do you have a lower EPS, you have a lower multiple assigned to it from the market. And so when you get that fall in EPS and EPS multiple, that's when you get those big gains, both from shorts and the vice versa on longs as well. And here's a look at PayPal today, which got hit really hard on big volume. 68 million shares, finished right at its lows, down 12% after it gave softer guidance as well. Contrasting that was Planeteer, up 23% as it came in with better than expected numbers and guidance as well. But you have to remember, this is off a low base. If we just go out to a weekly chart, we can see it's gone absolutely smashed. I remember back here in late 20, early 21, there was so many people loving this stock, saying like it's the next best thing. You know, Kathy Wood's in it, all in. This thing's going to the moon. But once again, valuation matters. And I could see that on our stock fair value indicator for the stock because it got up to $45 a share, but our fair value got up to $16. So it has always been overvalued. And even today, we've still got fair value at $5.34. So even though technically the price looks like it's bottomed and possibly been accumulated, I wouldn't touch the stock either long or short here. Because fundamentally, I still think it's overvalued, but technically it looks like it's been bought here. So this is just one I'm staying out of. Got Carl Icahn's company reporting tomorrow, and the stock held up a little bit here today, up 3.7%. Be interesting to see what they say after they've been attacked by the short seller Hindenburg Research. I'm sure they've got something to come back at it with. But there's some pretty strong allegations they need to fight back against, so it'll be interesting to see what they come out with. Deutsche Bank still holding above its 50, and PacWest, Western Alliance, and Zion's Group with First Horizon just still hanging in there. But skating on thin ice, in my opinion. They could go the way of First Republic or Signature any day. Same with Schwab, just hanging in there around the lows. And this is the hardest, biggest one of them all, so we're keeping eyes on this one. Okay, back over to the main indices. Okay, so the market is really calling up here in a tight range, and remember there's a lot of symmetry in markets. So the more extreme we go one way with price, volatility or valuation, the more extreme we can go the other way. And so the markets really may uncoil themselves here over the next couple of days with all this debt ceiling mess and inflation numbers coming in. Global central bank liquidity out there actually decreased again today, and we've got a healthy 250 point bearish gap between that and the price of the S&P. And the market just continues to trade really weak and flat, and then we can see that here on a hidden divergence indicator with really shallow readings, and on our range strength we're trading really thick here with a 12 reading, and that's evident across all indices. We can see that in equal weight. Stocks actually lost their 50 today, and negative on our hidden divergence, trading thick on range strength. Same with the equal weight NASDAQ, that's trading below its 50-day on really high range strength and negative hidden divergence. Same with the Dow, mid caps and small caps as well, trading below their 50, but still in this sideways thick movement. And with the market calling up like that and some big news events just around the corner, I've decreased my gross exposure and net exposure down to 20% net short. So I'm just slightly bearish tilt here, and I'm just kind of like the market in a wait and see mood to see what happens. I don't want to have any big positions on going into the rest of this week. And so tomorrow should be an interesting one. Thanks very much for tuning in again. And thanks to everybody for your nice comments yesterday and supporting the channel. I really do appreciate it. And I hope to see you all again tomorrow afternoon. Thanks very much. Cheers.